Hey everyone, hope you guys are all doing well. Happy Saturday on my part as well. Just listen to the tail end of Hubert's presentation. Always really, really good stuff. What we're going to talk about here today in my little hour that I have is we're going to talk about a strategy that it works in any market environment. Just maybe let me get that out of the way, but it's within the current context of what I still think is a bear market in equities in the broader perspective. We want to show you why this is an important strategy. In my opinion, it's imperative to use. We use this on the research side, also on the money management side for our clients. So this is something that I would highly encourage you to practice. So I'm just going to get right into it without any further delay. But before we get into the actual strategy, I want to just take a few minutes, if it's okay with you guys, kind of go over the market, the way we see it, why we think it's it's still a rather precarious situation out there, and I think that'll help us contextualize things a bit better as we go into the strategy. But about 5 months ago at this point, we entered, I think, a new era. Not only did we enter a new decade, but here's some facts around the S&P 500. If you take the long-term average of the S&P, the last 90 years, you will see that the S&P on average has returned about, it's almost say 10% per year. And the problem on this is that over the past 10 years, the returns in the S&P have been almost 40% more than the average, so about 14%. And there's a lot of reasons for that. We've had a lot of multiple expansion in the markets through the prolongation of the I guess the economic expansion due to various low interest rate shenanigans, for lack of a better term. I don't mean that in a bad way necessarily. It just is what it is. But it has essentially brought a lot of returns forward. So we think that the next decade, the one we entered about 5 months ago, is going to look very, very different than what we just saw over the past decade. We're thinking you're going to see equity returns, if we kind of keep it S&P 500 centric, probably more somewhere in the range of 3 to 5% per annum, which is about a third of what we've seen in the past 10 years on the average. So this is going to make it very challenging for a lot of people who are index tracking, for a lot of people that follow mutual funds, which a lot of them are basically closet index huggers, as we call it in the industry. And so there's going to be, I think there's going to be quite a rude awakening for a lot of people, and they're going to have to find themselves looking at much, much, much lower returns, not only just in the bond market with yields at essentially zero, I'll talk about that in a bit, but also again in the equity market. So to kind of help you put this into further perspective, here's a couple of problems that we are seeing with the current setup in the market. And this is aside from the economic backdrop, which of course isn't very good, to say the least. Here are a couple of major problems that I think it's just worth being aware of. So there's something called a stock buyback. Sometimes companies buy back their own stock, and they do that because they have a lot of conviction in what they can do with the company. And the blue line on that chart on the right-hand side of the slide is the US corporate buybacks in dollar amounts over the past decade or so. And you can see that this line is much above that yellow line, which means basically that the largest buyer of stocks over the past 10 years by a gargantuan margin has been companies buying back their own stock. What's been happening though over the past couple of months or so is because of again, economic slowdown. In fact, it's been more than that. It's probably been about 6, 7, 8 months now that companies have slowed down their buybacks, and over the past 2 months literally stopped them. A lot of them, not all of them, but a lot of them. So the bid in corporate buybacks has essentially, probably by our estimation, at least gotten cut in half, maybe cut down by 2/3. The question you have to ask yourself is that if that bid is out of the way, Fed or not, who's going to pick up the slack? And I think this is just one thing to keep in mind. Another way of looking at this is to understand that over the past 2 years, so 2018-19, we actually saw for the first time ever 2 consecutive years where S&P 500 buybacks actually surpassed CapEx. So companies bought back more stock then they invested in their own company, meaning, anything from paying their employees, investing in employees, and all sorts of other investments. So that's a little bit frothy, and again, it's for that reason, it's not at all surprising to see this pullback. Another thing that's happening is because of the slowdown in the economy, we're seeing dividends getting cut, and so these are major problems from a structural perspective as to who's going to be the net buyer in the equity market. Again, keep Fed buying or not, and by the way, Fed's not buying equities, at least not yet. But here's another thing I want to keep on your radar, I should say. And this is a very simple chart. It's got 3 asset classes on it. The blue line is stocks, the golden line is gold, you guessed it, and the green line is bonds. And so what you notice is that about a year ago, we started to notice a very strong and persistent bid in gold and treasuries. And this continued along with the equity rally, and we made a massive deal about this all over for our clients, for sure, but also even on the public outlets like YouTube's and in certain public webinars and Twitter and everything else, and made a really big deal of that. This is just simply not sustainable, and we're going to see equities at some point be punished for that. And of course, we all know what happened in February, March. And we're actually seeing something very similar happening again right now, where gold and bonds, relatively speaking, are holding their bid very, very well, and equities are once again almost kind of whistling past the graveyard. So I think this is interesting, and I would not be surprised if equities are finding it very, very difficult to go higher from here for quite an extended period of time, at least in any meaningful way. Here is the Russell 2000. This is a monthly chart, and this is some very, very simple overhead technical resistance. You can see what used to be support may now become resistance for the Russell 2000. And of course, the Russell 2000 has a lot more stocks in it than the S&P 500, which, by the way, the S&P is a bit of a tilted index, if you will, and that it's heavily weighted in just a few, if you will, mega cap stocks like Apple and Microsoft. And that does make things taint things a bit. Gold, still very bullish from a trending perspective, but makes a lot of sense in this environment with monetary debasing going through the roof. We think we've entered a new major bull market in about January 2019. We've been structurally bullish gold ever since, and we think that should continue to go to the upside, including other metals like even silver, dare I say. Let's quickly go back to the Nasdaq 100 though, and here's an interesting chart. So what I did here is I took the Nasdaq 100, I divided it by the New York Stock Exchange Composite Index, which has about 2,000 tickers in it. And you can see that ratio of Nasdaq 100 versus New York Stock Exchange Composite is above where we were in the internet bubble in the year 2000. And that was quite a stretched period back then. Now, this is the price chart, but if you were to look at volume, in terms of volume of the Nasdaq 100 versus the New York Stock Exchange Composite, it's literally the same exact chart. So all the volume right now, relatively speaking, is happening in the Nasdaq 100, whereas the average stock is kind of getting left out, if you will. The S&P 500, I know everyone is probably wondering, Serge, what the hell's going on with the S&P? This is what's going on. You can see the long-term weekly chart. This is a chart, the channel here stretches back to 2009. You can see we overshot there in January, February, we overshot in the fourth quarter, and then coming into January, February, undershot in February, March, and now we're basically back to the upper end of the long-term channel. And we think upside here is very, very limited. Now, to put this in a little bit more perspective in terms of when you have a market crash, what tends to happen? So here are a bunch of market crashes of the past. Some of the more notable ones, 1980, 87, 2000, 2008. And in each one of those crashes, it took over 2 years to get back to sustainably, I might add, to the previous all-time highs. Now, we have seen a very, very sharp recovery with the Fed essentially, opening up the dam, DAM, in terms of liquidity, and that I think has probably overshot things a bit. But for the most part, if history's any guidance, we should see it's very, very difficult for equities to push meaningfully higher from here, I should say. So we are probably thinking that we're going to be capped here for quite some time. The 2012 crash, I'm going to call this a crash. I only put it in there just for comparison purposes. That was only an 18% drawdown. of course, what we saw here this year so far was a 30% drawdown, and we'll see how long this takes, but we should be quite capped. Just quickly going back to bonds, and this is just another thing to worth noting, kind of going into a bit more detail what I mentioned before. The bond market is telling us a very, very different story than what the equity market's telling us. And again, the gold market's saying something very similar to what bonds are telling us, which is that no, we are probably going to be capped here in terms of growth for a long period, for an extended period of time, I should say. And the equity market's getting ahead of itself. So that's just an FYI. These are bond yields, by the way. So what this looks like is bond yields going lower, which means bond prices will go higher. This is the 5-year yield. I think we went out about 38, 40 basis points last week. Just quickly on me, this is my mug, Serge Berger. I originally come from a bit more of the investment banking side of things at JP Morgan, then moved on to hedge funds and family offices, and for about 10 years now at our own company, doing also the research and money management, all that kind of stuff. And so the thing I'm about to show you today is something that I've practiced for the most part my entire career, the strategy. So we have a lot of context and how it works in different market environments. Now, I do have a quick question for you guys. How many in here, type in a yes if this applies to you, how many of you have it one of your goals to generate an income from the stock market, like some sort of a positive return on a quarter-over-quarter, month-over-month basis? Type in a yes if that applies to you. And what the reason I'm asking this, by the way, is just I'm not writing down your names. There's a reason why I'm asking is I'm putting this question out there because most people are not aware consciously that is one of their goals. So most of you are probably going to type in yes, unless you're not listening to the webinar, you're typing on your phone or whatever. But for the most part, everyone has that as part of their goals. So here is the thing: if you take a 12-month period of the S&P 500, the returns, if you break them down month over month, are all over the place, and it's almost doesn't matter whether the S&P ends up having an up year or a down year. So for example, here we took a 12-month period, and you can see during this 12-month period, the S&P had up months, big down months, and everything in between. And the problem with this is that if you are having the goal of having a quarterly positive return, month-over-month positive return as an income stream, remember the average millionaire in the United States has 7 sources of income. And so I think another source of income was an interesting proposal for a lot of people. And so, but the problem is if you are just going to look at the month-over-month performance of the S&P, most strategies out there track the S&P, like it or not. Most indicators do as well. And so you have a very high probability, unfortunately, to have a very random return on a quarter-over-quarter, month-over-month basis. This is the return stream annualized over time of the strategy that I'm about to show you. And not only can you make a lot of money, but more importantly, you can see it's much less all over the place. It's a much steadier stream of returns. This here is the past 14 or so months of the S&P 500, just to kind of highlight this. So for the past 14 months, we've seen giant up months, giant down months, and choppy all over the place. And this is the problem that a lot of people have when it comes to trying to generate an income. Does that make sense, folks? Right? So putting it another way, this is a chart here of a mountaintop, mountain range, I should say, which you guys are probably asking, what the hell is this? So a lot of people's returns when they trade or even invest is they make money for a bit, and then they have like 1 or 2 losing trades and they give it all up again. And they repeat that pattern, and they're never really actually making money. And I'm sure a lot of you are probably nodding right now. It's very frustrating, not only because you're not making money, but the psychological impact there is very large, meaning it really wears on you to spend so much time and not making money and just kind of trotting sideways. And so what we have found over trading for and teaching this strategy to clients all over the world, from institutional clients to retail clients all over, and anything in between, is that there is a desperate need for a market participant to have something that has a stable return over time on a month-over-month, quarter-over-quarter basis. And there's a specific reason why, and I'll go through that in the next slide. But what we know is that if traders were to, let's assume you were to receive, someone were to give you, whatever, $3,000, $5,000, $10,000 at the end of every month, regardless of how you performed in the markets. Wouldn't you agree that you'd be more willing to stick to your rules? You'd be less giddy to jump after trades. You'd generally approach the market more calmly and do more research. Most of you probably agree. So, and by the way, it doesn't matter whether you are working full-time, part-time, maybe you're retired or soon to be retired. This is something that really, really works because it's also doesn't really take a lot of time. So to dig into this a bit deeper, like I promised a second ago, here's the problem. A lot of folks, when they look at the market, they come into this business, they say, you know what, I need to make $3,000 a month or $5,000, whatever it is. But the strategies they use are very, very ill fit to even give them any hope to have that kind of return. So we're going to show you something that gives you a much better edge to make this happen. But here's the thing. So a lot of people have a stagnating or losing account, right? And then that in turn, it's like a snowballing effect. And so what happens is as you're not making that steady return that you want, you lose confidence in the strategy or maybe even in yourself. And then it's all downward from there, right? You start breaking rules and forcing trades, and before you know it, you're essentially gambling. And that really doesn't work. And I'm sure a lot of you have probably done that before. I certainly have done that before in the beginning of my career until I started to learn better when I was working for the banks and the prop trading desks and all that kind of stuff. So what we're going to show you here right now is a strategy that does the following three things. First of all, it's very low stress, which is nice. It's very high probability. That sounds nice too. But most importantly, it's very repeatable. We're talking about a strategy that has 80 to 90% profitable trades. So out of 10 trades, you should have about roughly between 7 and 8, 9 profitable trades. It doesn't require a lot of time. And here's the other important thing. The 1 or 2 losing trades out of 10 on average, they're not going to wipe out the gains of all the past 8 trades. That's really, really, really important because a lot of people can tell you, oh, they have a high hit rate. But then what they will tell you is that, well, I'm 90% profitable. But what they don't tell you is that the 10% of trades that they lose on, they wipe out all those gains. And this strategy, if you do it properly, the way I show you, it will not do that. So at the very core of this strategy is this concept of a steep slope that goes vertical. So you can look at this chart here. You can see Amazon has had a steep run, and then it basically went vertical. And at some point, that rally becomes no longer sustainable, at least for a period of time. You can also happen on a downside. You can have a very sharp drop and then a vertical collapse, and then at some point the downside becomes essentially almost not possible anymore, at least for a period of time. So when these extreme moves happen, from steep moves to parabolic, either on the upside or the downside, the implied volatility increases or becomes elevated, meaning options get a little bit more expensive. Investor fear or greed reaches extremes, and as a result, the reward to risk for what's called a counter trend trade become absolutely amazing. And I'm going to show you exactly what that means. Now, how many people in here, or who has traded an option before? Type in me, if you've traded an option before. I'm just curious how many people have. Again, I'm not writing down your name. I'm just doing this to make you guys engage and make sure you're paying attention because it's about to get really, really important. Okay, so a lot of people have, some people have not. It doesn't matter at all whether you have it or not. What I'm about to go through on this slide is to kind of, this is really important what I'm about to show you, what I'm about to say. So whether you've traded options before or not, you are one day, sooner or later, going to hear the following statistics. These following statistics are technically true. Let me be very clear. But unless this is done properly, these statistics are not only useless, they're also very, very dangerous. So let me just go through them right away. The odds are strongly in favor of an option seller, of someone who sells options. Basically, what people will tell you is that more than 75% of options that you hold to expiration expire worthless. So if you buy a call and you're going to hold it to expiration, the odds are 75% that you will lose money, meaning you only have a 25% chance of making money. Let me repeat that. If you buy a call or a put, you hold it to expiration, and that's all you do, you only have, by definition, on average, a 25% chance of making money. It's true. Now, what they'll tell you is that if you do the opposite of that and you just become a seller of an option, you should, by definition, then have the opposite odds, right? You should have a 75% chance of making money. Now, this is true, But there's a huge problem with that. And that's the following, which we'll address in the ensuing slides. If this isn't done properly, this is very, very, very dangerous to know or to believe. And again, this will make a lot of sense here in just a few minutes as we go through this. A lot of people are also told to do this thing called time decay, theta. Has anyone ever heard that before? They want you to play the time decay game. It's actually extremely dangerous, believe it or not. And there's a reason for that, and I'm gonna hopefully open a lot of eyes here in a couple of minutes as we go through these slides. So here is what we're gonna do together. We're going to do the following 4 steps. You guys can take a picture of the slide if you want to, write it down, whatever you want, but these are the 4 steps that we're gonna do. We're gonna, first of all, look for these very steep slopes that have gone vertical and give us essentially a sign of exhaustion. And then what we'll do is we're going to make sure that implied volatility is at least somewhat elevated. That's important. And then we're going to make sure that the options we're looking at are very liquid, right? You never want to trade an illiquid option, just like for the most part, you want to never trade anything illiquid at all. And then specifically what we're going to do is the following. We're going to be selling far out of the money call or put spreads using options that expire 2 or more months in the future. Now, this is very important. Let me just say this. If you've done something like this before, I can just about guarantee you with like 95% certainty that you've never done exactly what I'm about to show you. How do I know that? Number one, we see what's being taught. Number two, we see what's being done in the market through our insight of brokers and other market participants. So, and then very importantly, we're going to be rinsing and repeating this strategy on a monthly basis to really create that income machine, that base of income, so you have another source of income from the markets. Now, again, what we're going to look at here is some steep slopes that go vertical, because at some point, the rally just becomes no longer sustainable, at least for a period of time. Usually, we're talking about a 2-week period here. Same thing here, Netflix, steep move, gone vertical. At some point, it simply will no longer go higher for a period of time. So again, when slopes go vertical to the upside, then the upside becomes essentially capped. Or if they move to the downside sharply, then the downside becomes floored. And so, in other words, the asset will tend to stall in price. And that's really, really, really important. And actually, what you'll see quite often is a sharp mean reversion move in the other direction once the stock or whatever the asset is in question becomes so severely overbought. We're not betting on that, but you will see that's kind of like the bonus payout. So what we're going to do together right now is, for the next couple of slides, we are going to look at some historical examples, some historical trades that we've done. Once we've gone through a couple of examples here, we will then go together live into the market or into the current market environment, and we will prove to you that this works. Because it's one thing to teach you how it works. I want to make sure you actually see that I'm proving to you that it does actually work, right? Those are 2 different things. So I will prove to you that I'm going to basically ask you guys to kind of blindfold me here just a few minutes, and then I'll prove to you that the stuff actually does work. So here's a chart of Facebook, and you can see Facebook over time there. At the time when I took this chart, took this picture of the chart, I should say, had a steep incline within these 2 parallel lines, and it had, a few of these vertical rallies. So every time it went from that steep move into vertical move here, and here, and again, actually here as well, just the chart got cut off here, it ended up mean reverting back into this channel. And the point is that it stopped going higher at some point. That's really the key. So you'll hear me rephrase this here 100 times over the next few slides to really make sure you understand this. So let's go into an actual current chart of this. I'm going to bring over a charting platform that we use, and just so I can annotate the chart. So this is, again, we're still looking at the chart of Facebook. The point in time you want to focus on here is, again, this is the same channel I just drew on the slide. We're just now into an actual live or a current chart of the, or I should say a charting platform, I should say, so I can make annotations. So you can see, again, this is the long-term steep channel. That's those two black lines, those 2 parallels. These are daily charts, and you can see the stock here had a very sharp move to the upside, to the upper end of the trend. So again, for going from the steep move to a rally, a vertical move. Now, when the stock gets to this point, what are some of the things that you could do? Well, if you own the stock, I suppose you could take some profits, right? Would probably be quite prudent. You could also, if you want to be aggressive, you could probably buy a put, right? I would argue you could probably even look to maybe short the stock, right? But who can tell me if at this point in time here you are you are shorting the stock or buying a put? What is the one thing that the stock has to do in order for you to make money? So if you're up here and you buy a put or you short the stock, what does the stock have to do for you to make? Who can tell me that? If you short the stock here or buy a put, what does the stock have to do? There's only one thing it can do in order for you to make money, right? It has to go lower. Exactly. Would you guys agree? If the stock does not go lower in direction, you will not make money. Agreed? Right? So if the stock does not go lower here and you short it or you bought put, you will not make money. Excellent. So, but let's think about what the stock can do at that point, as it can at any given point. It could go sideways, right? It doesn't have to go lower. It certainly can go sideways. Of course, it can go lower, right? As we just said, but it could also go sideways, right? You guys all know this, and that's always the annoying thing, inconvenient, that it could do one of three things. So in other words, the stock at this point, as at any given point, can do one of three things. Now, if you guys agreed with me before that if you buy a put or a short the stock and it must go lower in order for you to make money, but the stock can do one of three things, what's the probability of me making money, all else being equal? Who can tell me that? It's a 1/3 chance, right? You have a 33.3% chance of making money. Correct. Now, in my world of being in investment management my whole life, investment banks, money, all that stuff, this is called gambling. A 33% chance of making money is essentially a gamble. So instead of making these so-called directional bets, we like to make a different bet. The bet that we like to make is not of where the stock will likely go, but we are trying to make a bet of where the stock is most likely not going to go. I want you guys to really think about this, what I just said. It completely will change the way that you look at the market. So here, the only bet that we made at this point is not that the stock has to go lower, but we simply said, we don't think the stock is going to go all the way up here. And I need to make this a different color so you guys can actually see this, right? That's the only bet we made. So in other words, the stock could have gone lower, which it did in this case, and we would have made money. The stock could have gone sideways, we would have made money. The stock could have, even in this case, rallied about 8% against us. We could have been 100% butt naked wrong, and we could have still made money. Right? Now, there's just a really couple of important bits here that are important to understand. So please stay tuned to this, because this is not it yet. We have to go into a couple of small details that are unbelievably important. So let me just kind of explain to you how this worked in this particular case. So we, at that point in time, instead of shorting the stock or buying a put, we sold what's called a bear call spread. It sounds much more complicated than it is. It's literally one or two clicks of your mouse on the broker, on your broker platform. And what we did is we sold to open a 125 strike call, that's here, and then we bought against that for protection. This is all as one trade, a call at the 130 strike, so $5 higher in this case. And we actually received money in our broker account for this trade, which means that we actually received $1, or this translates into $100 per options contract deposited into our broker account, or $1,000 deposited into our broker account if you would have done this with 10 options contracts. Now, in this particular case, the stock did go lower. Now, I will show you guys examples in just a minute where that didn't happen and we still made just as much money. But by February 8th, so a few days later, the stock went lower, meaning that spread of $1, so the $1,000 we received with 10 options contracts, was reduced down to $240, meaning we got to keep the difference, which means we made $760 with 10 options contracts. And the stock didn't actually have to go lower for us to make money. It just didn't need to go completely 100% dead wrong against us, more than 8%, in which case, unless that happened, we would have still made money, right? So who would agree with me so far? Again, there's more to come. There's a couple of more important bits here in just a second. Type in yes if you can see that this is a higher probability strategy to turn a profit, all else being equal. Who agrees with me on that? To turn a profit, right? It's unquestionable. It's you cannot argue that point, right? So this is important to understand. Now, what is our goal in trading and investing? Our goal is to put ourselves into a position, in the highest probability position, to turn a profit, period, at any given trade or investment. Agreed? Unfortunately, a lot of people come into this and they say, I need to hit a home run on this trade and on every other trade going forward. That attitude will get you killed over time 100% of the time, right? You need to give yourself an edge to turn a profit, and that's what this strategy will do. Okay, so let's go into another really important point. And if you guys are doodling on your phone or you're whatever you're doing something on another screen, I would urge you to quickly bring your attention back to the monitor because this is really important now. So you guys saw that this trade was put on there in the month of February, correct? But you guys can see that we used April options. We didn't use options expiring in February. We didn't use options expiring in March. We used April options. But let's assume for a minute, let's assume that instead of using April options, let's assume we would have used February options. Let's assume we would have used February options, right? So let's assume what would have happened if we would have used February options, like short-dated options, and let's assume the stock immediately rallied against you, 5%. What would have happened to your trade? You would have taken a really big, nasty loss, right? Because you're using a short-dated option. Basically, you would have taken, like, on your car, you would have just lost like 3 out of your 4 wheels. And that sucks. But by using April options, even if the stock would have, say, completely rallied against us immediately when we put the trade on, we would have only lost, say, 1 wheel, right, on your car. Bring it back to the garage, push it back, whatever, and you can get it fixed and you all set. In other words, you're taking a small loss. And this is really important to understand, right? Because we're using options expiring usually 45 to 75 days out, but we only hold these trades. The average holding period is about 2 weeks. Folks, the fact that we use options, we sell option spreads using, again, expiration of 45 to 75 days out, but we only hold these trades on average for about 2 weeks is literally the opposite of what 98% of people do. It's literally the opposite, and that's probably why it works so well. All right, so this is really important. Give me a quick guess if this makes sense so far. Again, we're going to go into more details and I'll show you guys how this works. I'm going to prove it to you that it works as well. All right, this is unbelievably important. So here's just a couple more examples. So here's in Tesla, it's a stock that everyone knows. So I'll show you this. So we had a steep rally and then a complete sharp drop to the downside. And so what's happened there is we, instead of buying the stock, which would have been risky in our opinion, we simply said we don't think that at this point in time here, the stock is going to drop more than another, I think it was almost 20%. So we sold what's called a bull put spread. We sold options way down here and we bought, so we sold the June 120 option, we bought a 110 option, we received deposited into our account $225 per contract or $2,250 into our broker account with 10 options contracts. You can see the stock there over the next few weeks, it did go higher. And then that spread was reduced down to 43 cents, meaning we got to pocket a profit of $1,820 with 10 options contracts. But again, the stock didn't actually have to go higher. It could have just as well gone sideways or even lower. So here's the trade we just did, for example, in the S&P 500 there in March. And I'm just showing you this because this is one that everyone knows and like an index. And so here's just what we did. So on March 16th, the S&P 500 was down about 30% over the course of a couple of weeks. 30. I think it was 28%. And then instead of buying the ETF, which we thought would have been way too risky, which would have been a call to say that the index goes higher, we simply said, you know what, we don't think that the stock is going to drop more than another 18% over the course of the next couple of weeks. So we sold there on March 16th, we sold a June 190 strike put, and we bought against that at 185 strike put. We received $1,050 for that. And by March 24th, which was 8 days later, the S&P 500, even though it round tripped a little bit, it was at almost the same exact spot where it was on March 16th. But because we didn't buy the S&P, we didn't buy a call, we didn't buy a call spread because we sold what's called a bull put option spread, we made 11.4% profit. So just to put this in context, if you would have bought the S&P, you would have made absolutely no money. You probably would have freaked out because you had to go against you for quite a bit. And if you would have bought a call, you would have lost money for sure. But we made 11.4% because again, we would have made money whether the S&P went sideways, which is what it did, against us to a pretty good degree, or of course if it would have gone higher as well. Can you guys see that? Now, one of the really important things about this strategy is to think like a pro. So the objective with this strategy is not to pick winners, but rather to make sure that when a trade goes against you, and we'll show you guys how this works in a minute, you just simply get out. But because we use options expiring 45 to 75 days out, we actually have a living chance to get out of a trade when it goes against us, unlike when you use short-dated options, right? So this is really, really important to understand. So by doing this, the winners basically just take care of themselves. Like there's really nothing for you to do, but just to essentially make sure you cut the losers. And you can actually do this both in actually hitting the button because you're not paralyzed, and psychologically is not a big hurdle because you'll see the losses are small when it goes against you anyway. So this is really, really important. So the way I really want you to think about this is I would love to get you to the point where you look at the credit spreads as like your base income strategy that you focus on primarily at the beginning of every week, at the beginning of every month, quarter, or whatever your time frames are. And so that's what we do. So when I come into the trading day or into the trading week or into a new month, my first priority is to find trades to build an income that we can then use. Maybe if we do some day trades or swing trades, we can still do all those things, but we need to have that income. And that's really, 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 really important. Okay. So before we go into the live charts, and we're going to go into live charts in a second, I want to play a quick game called Follow the Indicator. Can you guys all see the blue arrow? So you can see that to the right of blue arrow, what did the stock do? It went lower, correct, but more importantly, it stopped going higher. Agreed? The stock stopped going higher. Or here, for example, in Alphabet, what happened to the right of the blue arrows? The stock stopped going higher, at least for the following 1 to 2 weeks. That's all we're looking for. We're looking at a time frame of 1 to 2 weeks on these trades. Or here in this ETF, you can see what happened to the right of the blue arrow. The stock, or in this case, the ETF stopped going higher. And ultimately, actually totally fell apart, but that's besides the point. That's the bonus, right? You don't need that to happen. You make money already here, right? So this is important to understand. So what we're going to do right now is we're going to get to the point on the presentation where I'm going to actually prove it to you. So if you guys would like to, we're going to do, as Hubert before called, like a rapid fire session. If you guys give me a ticker symbol, I will prove to you that it works. So if you guys are type in some ticker symbols into the chat box here, I'm going to bring up the ticker symbols you type in, and I'm going to show you that this is actually working right now. Okay, so let's have a look. And I'm also going to call out your name so you guys know that I'm not just making stuff up. I'm just going to quickly type in your name. So this is from Aaron, and he wants to look at BA, Boeing. So this is Boeing, BA, Aaron, and you can see that Boeing had a arrow here. It stopped printing on the 9th of June. And since then, the stock then ended up dropping 22%. So what do you do when that arrow no longer prints on June 9th? You sell a call up here, you buy a protective call against it, you generate the income, you keep it on for 1 to 2 weeks, and you move on. Okay? And again, I'm just taking in names that you guys are typing in. This is really, really important. All right. Next one is And by the way, I want to make sure we take names that people actually know. This is important, right? So let's have a look at Tesla. This is from Jody Pedersen. Here's Tesla. Let me bring it down. I have to always go, just so you guys know, I have a different resolution on my other screen, so I have to always go back and forth with the chart. But this is Tesla. It printed here. And then what happened over the next couple of weeks? It stopped going higher, right? So you sell, you call, you buy a protective call, keep it on for 1 to 2 weeks, you generate the income, and you move on. Okay, how about CCL? This is Gerard wants to look at CCL. Okay, let's type in CCL. Here's CCL. Oh, look at here. We had an arrow that printed on the 8th of June. It stopped printing on the 9th of June. What happened to the stock then? Over the ensuing 2 days, it dropped 25%. Okay, what do? On that day there on June 9th, you sell a call, you buy a protective call, you generate the income, keep it on for 1 or 2 weeks, and you move on. Gerard, did you see that? Perfect. All right, we keep it on. The average trade is on for 11 to 14 days, right? Okay, NBR, I don't even, Troy, this is for you, Troy, NBR, neighbors, I don't even know that stock, but whatever. Here, Troy, first of all, you can see, well, let's just look what happened here the other day. It's just the most recent one. No one really cares about anything in the past, so even though, obviously, but here's NBR. You can see it stopped printing on the 9th. The stock then ended up dropping 40%. You could have sold a call up here, bought a protective call, keep it on for 1 to 2 weeks at most. Although in this case, the stock dropped so quickly, you could have taken profits after 1 or 2 days already. Make sense, Troy? Awesome. Okay, Amazon, sure. Let's have a look at Amazon. Let me go through here. Sorry, I have to always get the different thing here. All right, here is Amazon. All right, so it printed here in April, then it stopped printing the next day. So all we're looking for is to keep the trade on for 1 to 2 weeks. That's it. So do the math. Let's say 10 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So roughly here, you get back out. Again, you will make money whether the stock goes sideways, lower, or even against you to a degree. So you sell a call, you buy a protective call, you move on. Right. And again, I just want to make sure you guys see that we take the UAL. Sure, United Airlines. I think actually all the airlines printed this, because I just showed this to someone yesterday. UAL, United Airlines. The arrow stopped printing on the 9th. The stock then ended up dropping 25%. You would have sold a call, bought a protective call, generate the income, and move on. Okay? So this is our proprietary indicator of how we find trades that fit this strategy. Does that make sense? GNC, yeah, wasn't that one of the ones that just went vertical the other day? Helen, GNC. Okay, so first of all, it had an oversold signal here, there, or there in March. And then you can see what the stock did. It just basically went sideways. Now, this is a very low price stock. I would not use credit spreads on this, but I'm just trying to show you that the indicator works, right? So since the indicator stopped printing there, the stock is down like 27%. This is just the other day. Delta Airlines, sure, let's bring that up. While we're at it, here's Delta. It stopped printing also on the 9th. The stock then dropped 21%. You could have sold a call, bought a call, keep it on for, in this case, even just a couple days, and you would make money. All right, more tickers. How about SLV, silver? You know, it's interesting. We actually got structurally silver, bullish silver. Here's silver. Let me break SLV. It's just an ETF. Here, you can see it stopped printing there on March 19th. And silver, by the way, since then is up 45%, the SLV. What do? You sell a put, buy a protective put, keep it on for 1 or 2 weeks, and you move on. Make sense? All right. Yeah, very good. Okay, let me go through a couple more here just to make sure you guys can see this. While we're at it, have a look at gold. Sure, let's have a look at gold. Let me just quickly get here another one in. Here's this. Oh, yes. Let me type in, and I'm trying to find some tickers that you guys all know. Here's one. I see Kristen is typing this one in. This is also actually one that we gave as a trade idea to our members. It's in BJ. It's at BJ Whole Foods. You can see it printed an arrow here and then it stopped going higher, but this is just like a couple of weeks ago. And you can see the stock since then, it ended up dropping 10% so far, and the members just made money on this. Okay, so this is how it works. Yes. Intraday, by the way, is anyone an intraday trader? Anyone? I'm happy to show you NVAX. Sure, let's have a look at NVAX quickly. This is one of those stocks that's been in the news. That's why I've actually been talking about it as well. NVAX, overbought signal here. Then on the 19th of May, you got the go to put on a trade. You sell a call, buy a protective call, and this stock since then has gone down 21%. But for the most part, it has stopped going higher, right? That's the important point here. Okay, if anyone, I'm going to quickly show you guys intraday. So let's have a look at Apple. This is John. He wants to look at Apple intraday. Yeah, John, I'm calling you names so you know I'm not making stuff up here. John, Apple intraday 5-minute chart here. This is yesterday. Yeah, this is the live chart from yesterday. Okay, what happened after the blue arrow? Apple dropped 3.3%. I'm not making this up. I'm calling out your name. I'm typing in the ticker. All right. Sure. How about Russell 2000? Sure. Here's the Russell 2000 5-minute chart, IWM. It top ticked the overnight high yesterday going into Friday morning. You guys see that? So I'm just showing you, I'm trying to show you some stuff here, you know, so you can see I'm not making it up. Currencies, sure. How about euro dollar? Here is euro dollar. You can see there, this was on Thursday, I think. It top ticked. And then, of course, the euro basically had a sharp mean reversion move to the downside. Okay. Yeah. You guys see that, right? So I'm just taking your tickers. Cool. All right, folks. So what's important here to understand is that you can see that this is something that works, right? And I think one of the most important aspects of all of this is to understand that a lot of people are really looking to generate an income from the markets. You would agree, as you all said before, that you're looking to generate an income from the market. So this is a process that really works, and I want to introduce you to the options income secrets, because that's why a lot of you guys are here for, because you want to know how someone like me who's done this for a long time, how we're able to produce results on a month-over-month, quarter-over-quarter basis. So I'm going to introduce you to the options income secrets, and the options income secrets is here to really get you that monthly options, quarterly options positive return plan, to really get you to produce regular income over and over again. And I'm going to give you that low stress, high probability cash flow income strategy. The benefit here is that you basically have steady and regular income in your account, meaning that now you don't have to second guess your trades, and you know every month that you have a reliable strategy. You really put the odds in your favor, and quite frankly, dollars into your account. Now with this package, you're going to learn how to use options the way the pros do, the way I just explained here today. The benefit is that now you start trading with confidence, and you start trading with a process. And again, it gets a little bit easier every single day, which is the great thing. Is when you get to that point where it just becomes second nature, then it really, really is amazing. And trading is all about having a process. I really can't emphasize that enough. So we're going to give you a cheat sheet as well with this. And I really want you to have an edge in the market. And so, making money in the markets is not only about skill, it's also about having an edge beyond that. So we're going to give you the vertical X Pro indicator as well. So the one that I just showed you guys here today is all included. Now, the vertical X Pro indicator looks for extremely overbought and extremely oversold measurements to really give us the highest probability points where you can put on these trades. That's really what makes this indicator so great. It gives you the best possible setup. So I'm going to give you a platform and a foundation that whether you're new to trading or whether you've been trading for a while, you have the strategy. You now have a tool that you can rely on month over month, quarter over quarter, just to create that regular income. That's exactly what this does. And this indicator gives you the highest probability points to put on those options income credit spreads. There's actually a scanner that comes with this as well. And I'm going to quickly show you this, what it looks like. Essentially, you get the overbought and oversold signal. So it's super, super simple. Anything that's overbought, you just click on it here and it brings up the chart. or something that's extremely oversold, it'll show you that chart, and then you can look at the trade. So for example, let me click on this here. Let me quickly activate this so you can see this a bit better. So here, this is one on the chart right now. The one I just clicked on here, CLDX, you can see it's extremely wide. It's still printing arrows, but as soon as it stops printing arrow, it might be setting up for one of those mean reversion trades to the downside. Yeah. So you can install this indicator and scanner on Thinkorswim, on TradeStation, NinjaTrader, and on TradingView.com. So if you have a different broker like Fidelity or something like that, you can go to TradingView.com, and a lot of people are using this now. It's a website you can essentially create a free account on, TradingView.com, and you can then install it there once you've gotten the code from us and purchased it from us. So that's everything that's included here. Quickly listing up. So you're going to get the strategy, you're going to get an on-demand video course, you're going to get the indicator and the scanner, and you're getting live monthly webinars. Each month we do 1 to 2 of these live webinars. It's literally a lifetime deal where we give you a trade idea every single time, an actionable trade idea, and we are also going you through details of how to use the indicator, how to use the scanner, and how to and how to set up the actual trade. I'm going to go through more of this here in just a second, but just quickly, you can see what some of the people are saying here. This gentleman here, he's already paid for the cost of the first in the first couple of months of a couple of trades that he's done. We can show you guys pages and pages of testimonials. I think that's I'm sure we could do it all day long. But who is this not for? Just real quickly, I don't think this is for people who are looking to swing for the fences. So if you're someone that's more into trading for the fun, to get a kick, this probably isn't your thing. But if you're serious about it, if you can understand the value of putting on trades this way, if you can see that the edge that this is the edge that it'll give you, that you need, then this is something that you really want to have. And if you want to have another source of income, whether you're retired or just working part-time, full-time, whatever, this is something that I would highly encourage you to look at. Now, again, you're going to get an on-demand course with this, live webinars, the indicator, the scanner, ebook, and I'll go through all that here in just a minute. The course is full of all sorts of great stuff that you can use to really turn the strategy into an income machine for you. We're going to teach you how to diversify among different sectors and industries and even asset classes if you want to, and really turn this into a monthly income machine. So if you break this down, if you were to only get the course itself, that would be $200. If you only want to get the monthly lifetime webinars we do every month, basically, that would be $497. The indicator itself will be $2,000, and there's a new module we added for iron condors that's essentially priceless. The total package value is $2,700. We're going to give it today for the next 50 people 90% off, 90 for $297. Yes, that's only a one-time payment, so you don't have to pay this over and over again. It's a one-time payment. It's not a monthly payment. It's not an annual payment. It's one time. You own the course. You become a lifetime member. You own the scanner, the indicator, and you get to come back every single month for bonus webinars. So the next scanning session, just so you guys know, we just literally did one yesterday, and we're going to send you guys the recording of the one from yesterday. But the next one after that is June 26th. They're always recorded. Again, they're on the website, and this is how it works. So you can go to thesteadytrader.com/income. I'm going to quickly type this in for you guys. Let me see if I can make this happen here. Chat. Let me see here. Well, Jeanette, if you're listening, maybe you can type in the link as well. I'm going to do it as well here. www.thesteadytrader.com. Trader.com/income. There you go. You can go ahead and try that out. Let's go to some questions. Yes, so this is a one-time only payment, and you're a lifetime member. I hope you can see the value in this. I hope you can see how it works. I hope you can see that I'm just trying to prove to you that it works. You saw the signals it triggered this week, the week before, and on and on and on. It is an absolute beauty, this thing. And yeah, so to me, honestly, the most important thing is the monthly webinars. Every single month, we do 1 to 2 of these webinars, and we give you a trade. So just the one that we just did, gave people like a couple of weeks ago, was in BJ. Here, this one. The stock went vertical, the indicator stopped printing on the 26th of May. We told them to sell this call, buy this call against it, net credit of 95 cents. And I think this trade is not trading about 60 cents or 50 cents or something like that. So they're already sitting on a really nice profit in over the past, couple of weeks the trade's been on. So that's what we do every single month. So you're going to get a trade alert, a trade idea in each one of these webinars. We're going to teach you exactly how to use the indicator and scanner, and of course teach you the strategy. So that's really really important. Yeah, perfect. So Gene, Gene, you did this trade. You're up. So Gene is one of our clients. It sounds like he's up 50% already. If you trade futures, can you use this? Yes, of course. I mean, the indicator itself works in futures, if that's your question. It works in Forex, it works in futures. I mean, just to give you an idea, like if you're curious about the indicator here, this is just yesterday, E-minis. You see it printed here, and then the E-mini rallied 1.5%. All right, this is an intraday chart. Now, again, we don't do credit spreads intraday, but if you just curious about the indicator works intraday as well. If we have updates on the indicator, yes, they will be included. They will be included. So any updates on the indicator will be included. But yes. So once you, I know I only have a couple of minutes left, but I'll quickly show you this. When you get to the website, once you log in, it's super simple. You simply click on indicators, TST Vertical X Pro, and then you can choose the platform that you want to use it for. Thinkorswim, TradingView, TradeStation, NinjaTrader. There's videos. All the bonus webinars recordings are there as well. So this is a forever subscription, Roland. So you pay $297 right now instead of $2,700, and you get it at 90% off, and that's it. Like you become a lifetime member. You own the indicator and scanner for a lifetime. We do a webinar every single month. I think we've done like 14 of them this year alone. We did 3 of them, I think, in May. We're doing 2 of them in June. Every single webinar, every single month, we give you an actionable trade idea, and we teach you exactly how to use this and exactly how to put on the trades. Yeah, so Chuma, a good question. Again, that's why we do the webinars. That's the kind of thing we talk about in the webinar. If a trade goes against you, it's honestly as simple as getting out. Like let's have a look at BA, right? We just talked about BA extensively a few minutes ago because it just printed and dropped like a rock over the past few days. Like, let's assume on June 10th, let's assume the stock would have gone higher. If it goes high, you get out immediately. It's that simple. You know exactly where to get out. You know exactly where to get in. And because we're using options expiring 45 to 75 days out, you actually only have a small loss on the average trade, which is really honestly the secret of why this works so well. Make sense? Recommended broker account size. Honestly, I mean, you can use any account size. We have people with $5,000 accounts. We have people with $100 million accounts. I have family office clients who use this. So cool, excellent. Do you cover trading in the training how to get out of the? Yeah, for sure, James. So the reason why we do a webinar every single month, in fact, we're doing 2 of them a lot of months, is to teach you exactly how to get in and how to get out and when to get out if it goes against you and if it goes in your favor. Okay, that's all the things that's every single month. So again, sum up is $297, one-time lifetime access to all this, the monthly webinars, the course, the ebook, the indicator and scanner. I look forward to having you guys on board. I know I got to run. We've got some another couple of great dudes up here, and Jeanette and TT, keeping it real on a Saturday. Thank you so much.